Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamowen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today we're discussing the surprising departure of Rocket Mortgage from the Canadian market. It's quite a headline, especially given Rocket Mortgage's prominence as one of the world's most dominant mortgage lenders and the second largest in the United States.
Absolutely, Steve. Rocket Mortgage's exit is a significant shift, especially for those of us who have been watching the market closely. Their decision to leave Canada seems to align with their parent company, Rocket Companies, focusing more on the American housing market where they have a strong foothold.
Janine, it's fascinating and somewhat troubling that Rocket Mortgage, despite its resources and technological edge, felt the need to exit. The underlying issue appears to be funding. In the United States, lenders have access to government-backed entities like Fannie Mae and Freddie Mac, which keep the housing market stable. Here in Canada, however, the situation is different.
You're right, Steve. In Canada, the securitization market is more limited, particularly for uninsured mortgages. The 8 major banks dominate access to covered bonds, which are crucial for low-cost funding for these types of loans. This means smaller players like Rocket Mortgage face significant challenges in securing competitive funding.
And it's hard to imagine those banks willingly offering competitive funding to their rivals. The government claims to support competition in the mortgage market, but in reality, its policies often favor the big banks, particularly when it comes to uninsured mortgages. This lack of access to competitive funding is a significant barrier for non-bank lenders.
Exactly, Steve. It's a challenging environment for smaller competitors. The government's decision to restrict default insurance for refinances and other mortgage types back in 2016 has only compounded these issues. These policies were intended to mitigate risk, but they also stifle competition, which could benefit consumers in the long run.
It's interesting, Janine, that despite the perceived risks, Canada's mortgage arrears remain low. This suggests that the market is safer than some might think, even with the tightened lending standards and higher capital requirements for lenders. The government's cautious approach might be overly conservative.
True, Steve. The market's resilience, even in the face of rising unemployment and interest rates, shows that the safeguards in place are effective. However, the lack of competition means consumers might be paying more than necessary. A more competitive market could drive down rates, offering Canadians better options.
Absolutely, Janine. The average 5-year fixed rate for non-bank lenders is higher than that offered by the big 6 banks. This difference can add up to significant costs for families over time. It's a clear indication that more competition could lead to better rates for consumers.
And that's why it's crucial for policymakers to reconsider their stance. Encouraging competition in the mortgage market could have long-term benefits for Canadian home buyers, making home ownership more affordable and accessible.
Janine, it looks like we're seeing an uptick in mortgage delinquencies in Ontario. The latest data from Equifax shows the delinquency rate has risen to 0.22% in the fourth quarter of 2024, up from 0.19% in the third quarter. Although these numbers are higher than last year's 0.12%, they're still low compared to historical standards.
That's true, Steve. While the increase might seem concerning at first glance, Joanna Lang from Outline Financial points out that there's no immediate cause for alarm. Most borrowers were stress tested for higher rates, even when they secured lower interest mortgages, so many should be able to handle the current rates.
Exactly, Janine. Lang mentions that homeowners who initially took out mortgages at rates as low as 2.2% were stress tested at around 5.4% or 5.5%. Now, even if they renew at approximately 4.2%, They should still be in a manageable position, especially since they've paid down part of their principal over the years.
And let's not forget, Steve, that the Bank of Canada has been cutting interest rates recently, which should help ease the burden for those renewing their mortgages. The outlook for consumers is improving, and the feared renewal cliff might not be as steep as initially thought.
However, there are still some concerns. Lang highlights that individuals who have used their homes as bank machines might be in a tough spot. These homeowners have accumulated debt, and with house prices remaining flat, they can't refinance easily to cover it.
Yes. And while many Canadians prioritize their mortgage payments over other expenses, some might have to make significant lifestyle adjustments. It might affect their vacation plans or discretionary spending, but keeping up with mortgage payments remains a top priority for most.
Still, we should be cautious. As the CMHC noted, households missing mortgage payments for over 3 months might be dealing with broader financial stress. If these financial pressures persist, homeowners might eventually face the risk of default.
It's a reminder that while the overall number of delinquencies is low, each case represents a family facing challenges. It's important for us to monitor these trends closely and support those who might be struggling.
Janine, let's shift gears and talk about the recent rebound in the Canadian 10-year government bond yield. It's climbed back up toward 3.1%, recovering from a near 2-year low of 2.83% that we saw on March 3rd.
That's right, Steve. This rebound is largely driven by changes in trade policies and easing tariff measures. The United States has made some notable adjustments, like temporarily exempting automakers from the 25% tariffs and reducing tariffs on energy products to 10%. These moves have helped alleviate some of the concerns over economic growth.
Absolutely, Janine. It's interesting to see how these policy changes can impact the bond market. By reducing tariffs and potentially exempting goods that meet trade agreement standards, fears of a trade dispute escalation have been reduced, which in turn has influenced bond yields.
And it's not just the trade policies at play here, Steve. There are ongoing concerns about growth in the labor market that have prompted the Bank of Canada to make some significant monetary policy shifts. They've implemented 6 rate cuts since ending their tightening cycle last year and have unexpectedly stopped quantitative tightening, which has increased demand for long maturity bonds.
That's a great point, Janine. The Bank of Canada's actions are a clear response to persistent growth concerns and a softening labor market. By cutting rates and ending quantitative tightening, they are aiming to stimulate the economy and provide some stability to the bond market.
Meanwhile, we're also seeing yields on U.S. Treasury notes rebounding. This reflects a similar trend in the U.S., where the softening labor market and renewed expectations for fiscal consolidation are influencing the bond market dynamics.
Exactly, Janine. The interconnectedness of these markets means that shifts in one can often have ripple effects in another. It's crucial for us to keep an eye on these developments as they can have significant implications for the broader economic landscape.
Definitely, Steve. For our listeners, it's important to understand how these bond yield movements can impact mortgage rates and the real estate market. As bond yields rise, we might see a corresponding increase in long-term mortgage rates, which could affect homebuyers and those looking to refinance. Steve, let's turn our attention to the latest job market numbers in Canada. February saw a significant slowdown in job growth, with only 1,100 new positions added. This is quite a change from the robust gains we saw in December and January.
That's right, Janine. The unemployment rate held steady at 6.6%, but the stalling in employment growth comes as a surprise, especially after the significant increases of 91,000 jobs in December and 76,000 in January. Economists like Derek Holt from Scotiabank had expected another gain, so this was unexpected.
It seems like there are a few factors at play here, Steve. Severe winter weather led to 429,000 workers losing hours, and there's also ongoing trade tension that's creating uncertainty. James Orlando from TD Economics pointed out that deteriorating hiring sentiment might be starting to show in the data.
Yes, Janine, and Douglas Porter from BMO mentioned the impact of the trade dispute with the United States. He suggests that while the job market had been improving, the trade war has started to affect Canada's employment landscape.
It's concerning, Steve, especially since the labor force participation rate fell for the first time since September 2024. But there were some positive notes. Sectors like wholesale and retail trade saw gains, while professional, scientific, and technical services faced losses.
And with these mixed signals, the Bank of Canada is expected to cut rates by 25 basis points next week. The ongoing trade war concerns seem to be overshadowing the labor data, as Thomas Feltmate from TD Economics highlights the need to watch for signs of weakness in the coming months.
It's a delicate balance, Steve. While the Bank of Canada aims to provide economic stability, the situation in the United States also plays a role. They added 151,000 jobs last month, but their unemployment rate rose slightly, showing that the trade policies are having ripple effects on both sides of the border.
Absolutely, Janine. The interconnectedness of our economies means that policies and shifts in one country can have significant impacts on the other. It's crucial to keep a close eye on these developments as they can influence mortgage rates and the real estate market here in Canada. In our final segment today, we're highlighting some exciting news from the Canadian mortgage industry. Sharnjit Singh Gill and VERICO Superior Mortgage Inc. have been named as finalists for the 2025 Canadian Mortgage Awards. It's a great recognition of their hard work and dedication.
Indeed, Steve. Sharnjit Singh Gill has been selected in the category of Broker of the Year Regional for Western Canada, covering Manitoba, Saskatchewan, Alberta, and British Columbia. Meanwhile, VERICO Superior Mortgage Inc. is a finalist in the Brokerage of the Year category for firms with fewer than 25 employees.
The awards ceremony is set to take place on May 1st at the Toronto Congress Centre. It's a testament to the outstanding work of Gill and his team, who have been in the banking and mortgage industry for over 55 years. Gill's journey started in India, and he has since worked in the United Kingdom and Canada, making significant strides in each.
What stands out to me, Steve, is Gill's emphasis on honesty and hard work, which he credits for his success. He and his son, Raj Gill, have been recognized as top producers multiple times, including with Envision Credit Union and Coast Capital Savings. Their approach of going the extra mile for clients truly sets them apart.
Absolutely, Janine. Gill's philosophy of inform, empower, educate our clients seems to be their secret to success. This client-centric approach has earned them a spot among Canada's top 32 mortgage brokers in the CMP Top 75 Mortgage Brokers 2024 list.
It's inspiring to see such dedication to client service. Gill's story is a reminder of the impact that personalized service and integrity can have in the mortgage industry. We wish him and his team the best of luck at the awards.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights